Welcome back to Morning Trade Live. Let's focus in on the macro as we lead up to the opening bell on Wall Street. Joining us now for insight is Jim Bianco, president of Bianco Research. Jim, it's always great to hear your thoughts. Let's start out before we kind of dive into the macro picture. What is your thought about where the markets stand today?
You know, I think that they've really reached somewhat of an overbought level. I'm talking mainly about stocks right now, and even bonds to that extent. I'm not so sure we're going to see a big correction, but I think that, as far as a plateau goes with markets, they're going to grind kind of more sideways than any kind of a trend. And that fits with the larger macro theme, too, because we seem to be in a state of flux. What's going to happen next with the economy? I think it's slowed down in the first, 4 months of this year, and it seems to be picking back up ever so slightly. But others disagree with that. So that's why I think the markets will trade sideways as that becomes clear as to which way we're going to go next.
We've got a heavy economic calendar this week. We've got consumer confidence, consumer sentiment. We've got a fresh reading on GDP. I mean, that one may not be paid as much attention to because it's, a final estimate. But then we book in the week with PCE. What are you paying attention to the most when it comes to the economic calendar this week?
All of that, but I'd probably going to go off the board, and I would look at probably the debate on Thursday night. Whether or not that produces any kind of a surprise, I happen to think it's going to be kind of a boring non-event, but I could be wrong on that. If it produces a surprise, that could have some economic consequences. As far as the data goes that you mentioned, PCE is a function of CPI and PPI. That Wall Street is always very accurate on their forecasts. So that's at 0 and 0.1, 0 for headline, 0.1 for core. It shouldn't really move the markets that much because that's already priced in. And then probably the next thing that I'd be looking at, again, would be on Friday, and that would be the University of Michigan inflation expectation. That number has been getting a little bit more attention lately, and it's expected to come in at 3.1, which would be kind of a problem for the Fed that wants to cut rates if we can't get that long-term expectation number below 3%.
And then you said if there would be a surprise, what would be the surprise that would kind of make you really pay attention and say, hang on a second, we need to be paying attention to this?
So I guess I'll have to answer that in the big picture. And the big picture is I think the cycle changed with COVID in 2020 and that we're probably not going to have a recession anytime soon. I know that flies in the face of the soft landing, hard landing crowd. But what we're going to have is persistent inflation problems as a consequence of no inflation, of no recession. So if there's going to be a surprise, I tend to look for the surprises to be on the upside. And the upside is, the economy's doing better. Okay, well, that means more inflation. That means higher interest rates. And that's why we're going to have to deal with a level of interest rates with using the 10-year yield, a 4 handle or a high 4 handle. I still think that before the year's out, we're probably going to make one more run at 5% on the 10-year. Although my conviction level's down a little bit on that, I still don't think we've quite completed this upcycle. I am kind of structured a little bit more neutral because of that low conviction. But nevertheless, I do think looking past that, we are in an era of higher interest rates. And anytime you say good news, say higher interest rates. And that's really what the market has not gotten its head around, even though that's been the case for 4 years. And it constantly gets surprised by higher interest rates, and it can again.
You said for the 10-year, one more run at 5. When I look at it today, it's pretty range bound. Like you talked about, whether we're talking about equity or the bond market, you're looking at a narrow range right now. Inflation has been kind of moderating recently. Is your expectation that to see a big tick higher?
I think for the rest of the summer, yes, not necessarily for core PCE. There's a thing called the base effect in inflation, and that is if you look to a year ago, and the numbers that we had a year ago, they were zeros and 0.1s on the monthly reads of inflation. So unless we're going to print zeros and point runs for the rest of the summer, we're just going to continue trending sideways. I think we're going to do a little bit more than that, especially if this $80+ crude oil number does eventually filter into higher gasoline prices, and that we could probably see the year-over-year inflation numbers tick up to the end of the year. The Federal Reserve talked exactly about this, or Jerome Powell did 2 weeks ago, exactly about this base effect, which is why they upped their core PCE forecast from 2.6 to 2.8. In other words, what I'm trying to say is this is the low in inflation. This is it. This is about as good as it gets. We might tick a slight tick lower than we are now, but we don't expect a whole lot more unless you want to make the case the economy is about to fall apart and that will weaken demand and bring inflation down. If it doesn't, and I don't think it will, this is it. This is as good as inflation is going to get in this post-COVID world.
So you don't think that the Fed is going to reach its two handle that it's looking for this year or at all?
Well, if you're talking about year-over-year CPI, no, I don't think so. Year-over-year CPI bottomed at 3% a year ago. And so it has not made a new low in a year, and I don't think it will for the rest of this year get under 3%. If you're talking about core PCE, will it get down to 2.0? Not this year, unless you tell me the economy is going to fall apart. And again, I don't think it is. I don't think they're going to get to that target. That's why we've played this game all year. Remember in January, we were going to have 6 rate cuts for the year. Here we are now almost in July, and we're maybe talking about a 1 rate cut in the fall. And this is the game that Wall Street has been playing for the last year. The rate cut is always 3 to 6 months away. It never gets closer. In 3 to 6 months, it's still 3 to 6 months away. And that's because the data does not weaken enough. The inflation data does not come down enough in order for the Fed to pull the trigger. And I don't think it will for the balance of the year.
All right, let's talk a little bit about the consumer and how much attention we should pay to the consumer, whether we think about the confidence. The last confidence reading we had for May, it showed some improvement after a few months of declines, but under the hood, there were concerns about inflation and interest rates. How much attention should we be paying to the consumer confidence and sentiment metrics that we'll get this week?
Well, you know, you're asking me about consumer confidence, and I've been one that has argued that it's the world's most useless indicator, because what consumer confidence has become, that metric, is it's become a political metric. All of the movement that you can go from month to month in consumer confidence, they do give you a breakdown of self-identified Democrats or Republicans. It's either the Democrats or the Republicans change their opinion, not both. And that's what moves that number. So I don't put a whole lot of stock in that number per se, because it's more of a political opinion than it is of an economic opinion. Now, stepping back from consumer confidence, the consumer himself or herself has been the big driver of this economy. They are spending in a great deal. The Wall Street Journal had a story on Friday that the American consumer traveling to Europe is single-handedly holding up the European economy. The Conference Board does ask people, are you planning a foreign vacation? It's the highest it's been in 35 years of measuring that statistic. So what people are doing is they're spending, and they're spending in a big way. Yes, they're spending because inflation's pushed prices up, but they're also continuing to spend. And unless something comes along and upsets that apple cart, that they are going to continue to be the driver of not only the U.S. economy, but as the journal said, the European economy as well too. So they are the dominant force right now in the economic sphere.
I do think they're the dominant force. I think you make a great point about that. Yes, the American consumer is spending, and we often say don't underestimate the American consumer. But there are some cracks when you think about, say, credit, where that stands, and then we don't have visibility on BNPL. That's, you know, not really regulated the same way the credit card space is. So that remains to be seen how much of a crack in the armor will be. I do think overall, when you look at the economic metrics, there's more good than bad. So I hear your point, Jim, but we are going to have to put a pin in our conversation for time's sake.
Okay.
Jim Bianco, President Bianco Research, thank you so much for joining us this morning.